Okay, good morning, everybody. So today is Monday, and this is the last week of the semester. So it's good news, right? So the only thing we're going to do today is we're going to sort of finish up the content from Chapter 17, which deals with standard costing, and we'll get into the issue of the balanced scorecard and what that is. And it's really an important tool used by some companies, and there are all kinds of variations and twists on how that's used. But we'll talk about that. And the final exam is available. We made it available on Friday, 29th. So it's available now. And the due date is going to be, keep in mind the due date is going to be the 6th. And we really want to hold firm to that due date because there are occasions in which people, kind of get hung up on an exam. I would discourage you from using a cell phone, iPhone, smartphone. Some people do that, and the results often turn out to be really bad. So we get to a regular computer. A lot of times it's fine, but I think sometimes iPhone and tablet just doesn't really work that well. So I would encourage you to get to a computer, and in order to do that. But if you have difficulties, it gives us a couple days of slack in order to deal with it. The very last day of the semester is going to be the 8th, which is Sunday, and I've adjusted the due dates on the homework quiz and bonus for Chapter 17 to that particular date. So the exam you want to do by Friday. And my plan for the week is I'm going to finish up talking about the content in Chapter 17 today. And when we come back on Wednesday, I'll do some example problems and exercises from the back of that chapter. And I'll talk about what's going on with the exam. Some people have already taken the exam, and that's fine. You're free to do it. It's been available for some time. But if you haven't, we'll do a bit of a review session for you so that you have kind of a flavor and a feel for what is going on. And that's really it. Those are the last activities. Keep in mind that I know sometimes people say, hey, if something happened and whatever, I couldn't get this done on Sunday night. We really don't have much luxury. There's almost no slack, I guess, in the time frame because I'm literally going to be reporting grades on Monday, probably for this section on Monday morning. So the 9th. And so I really do not have time to do that. So my point is, and I'm telling you as some friendly advice, hopefully you take it as such, that I would not wait till 10 p.m. on Sunday to do the homework quiz and bonus. I think it's going to work against you to do that. So, all right. So any questions? I know we have a couple people on the Zoom call and whatnot. Any questions before we get going here to finish out what we're talking about on Chapter 17? All right. Well, let's do it then. Let's get to, we have two final learning modules in this particular, two segments in this learning module. And we'll talk about both of them today. We're going to talk about variance reports and also this issue of balanced scorecards. And for those of you, I think I mentioned this last week, those of you who are interested in management as a career, those who are business administration majors, balanced scorecards are going to be talked about in much more detail. I realize we're only sort of opening the door to that discussion, but to the extent that accounting information informs the use of these scorecards as a means of assessing managers, then it has particular value. But again, we're not going to be exploring every detail with regard to balanced scorecards. It's one of those things, and I think it sort of came into being about 30 years ago when I was still in the corporate world. We had all these different objectives, and we'll talk about how they're not all just numbers. I know that sometimes people get the idea it's all about financial measures, and it's oftentimes not, depending upon your particular role. So we're going to talk about that. Now, we talked about variance before, and we talked about this issue of variance as being favorable, that is positive variances, those which add to net income, and unfavorable variances, which are negative contributors to net income. And if we express it in terms of cost of goods sold, favorable variances lower cost of goods sold, which means that they add to net income. Unfavorable variances add to cost of goods sold, which lower net income. So if you think about it in terms of these are product costs, and we focus a lot in this course on product costs. And so if we take variances as being deviations from the standard, then we can see what the contribution is to overall profit. And again, as we've said numerous times, the goal of the firm is to maximize profit and to maximize the value of the firm. And so as a result, anything which adds to net income is good. Anything which takes away is not good. So that's obviously nobody came into class today thinking otherwise, I don't think. So, all right, so when we talk about variances, we'll talk about the idea that not all variances are that critical. If you're off by a dollar and producing 50,000 widgets, it's probably not a big deal. It may even be something that's praiseworthy if you're only off by a dollar. So not everything is, not every variance is something that requires an all hands on deck sort of approach. And I know that some managers don't always get that. I've worked for some managers who think that any kind of variance, even if it's a positive variance, they want to know why. And it's, and if it's small, it's probably not something that you want to really deal with. We have to understand that we're not always going to land on the target. And that's part of the budgeting process. And we said standardized costs and revenues for that matter, which we don't really get into in this chapter, but standardized costs are an outgrowth of the budgeting process. And so we have to know that we're going to have variances because we're not always going to land exactly on target. And how these reports are presented vary. And I really like this point because one of the themes that we talk about a lot in managerial accounting is that the reporting method and the style and how frequently is all over the board, depending upon what management's preferences are. We've talked about the fact that some managers like reports on a daily basis, just the big picture items as to how things are going. What are sales numbers for today? How are inventory costs looking today? That sort of thing. Other managers, maybe let's look at it from a monthly basis. I wouldn't think that you want to go beyond a quarterly figure because then we get into sort of the gap reporting to external users. So it really depends on how frequently you want this. And I know that I've talked in this class before about Warren Buffett, the great investor who owns Geico Insurance, among others, and he wants a report every day as to how many dollars of premium Geico Insurance brought in that day. That's just a frequency that he has mandated, and it's really subject to what management's needs are. And in terms of what the form is, it's all over the place. I can give you all kinds of examples of different forms. And I've seen lots of different examples, but they're all over the place and they're not prepared in accordance with the gap. And that's what we want to talk about. So, but there are commonalities. I know it makes it sound like it's the Wild West out there, but there are commonalities in terms of what the needs of management are, because the needs of management are always to maximize profit and to sort of minimize cost where necessary. But however you get there, whether you maximize revenue, minimize cost, however you get to maximizing profit, depends upon what the overall objectives are. And it also facilitates something called management by exception. I'll talk a bit more about that in a minute. This is, I think, a misunderstood concept in business. I think a lot of people have the idea that management by exception, and I think I probably am prone to this misapprehension as well, but the idea that you only hear from management when there's a problem, that sort of thing. And I think that's probably not an incorrect observation, but that's not really what management by exception is. Management by exception is the idea that as these, whatever the issues are, particularly if they're of a negative outcome, as they flow up to top management, these are exception items that have to be dealt with. And very often management does not deal with things that are going correctly, they deal with things that are going wrong. And that's part of what it means to be in management. And as somebody who spent lots and lots of years in management, I can tell you a lot of your day is spent dealing with problems. And if you don't want to be in management, and if you don't want to deal with problems, don't be in management. And it's pretty straightforward. And management always looks for the very significant variances. So the very ticky-tack, small things, not so much. Okay. And in terms of management by exception, I pulled up a website here. And if anybody wants it, I can give it to you if I can find out what I did with it here. But it was about management by exception. And I was going to give you a little bit more detail before we moved on. Let's see here. I don't want to spend a lot of time on this, but well, here it is. I guess I just didn't bring it up. So what is management by exception? It's the practice, and I'll just sort of, if you want this, and there's a PDF that goes along with it. If you're really interested in this concept, it's the practice of examining the financial and operational results of an issue and only bring issues to the attention of management if they represent substantial differences from budgeted or expected. Now, by the way, budgeted or expected that really lends itself to this idea of standardized amounts. And we'll talk about standardized amounts and then how, when they differ from what the actual are, we obviously have to report the actual for GAAP purposes, but for internal uses, though, we're interested in those kind of things. And by the way, the company controller, the controller is usually the chief accounting officer. That's I think we may have talked a bit about that earlier on this semester when we sort of laid out who's who in the organization. And maybe the controller is required. It may not be the controller, maybe somebody in the controller's office or somebody else. But they're based on whatever the policy is. So it's 20% higher in terms of cost than what's expected, then it has to be reported, and management can deal with it, ask questions, whatever. Now, one thing I'll say is this: not all variances, particularly unfavorable variances, are necessarily unfavorable to the big picture. And we have an example that's going to be coming up here that will show that not every time in which you have an actual variance or an actual cost that exceeds the standard, it's not always due to somebody who's fallen down a job or whatever. There may be a rational explanation, but that's what management needs to understand. Why is it? And let's figure out what's going on. So the idea is to only bother management, I like this term, bother management, with the most important variances from these directions. And so this is a pretty good definition. By the way, management by exception is, I can't give you one sentence or whatever as a definition, but I can give you all kinds of different issues that are going on. One thing I'll talk about here, and I know not everyone in this course is an accounting major, but a lot are, because 2120 is obviously the gateway to the next accounting course, this program 1135. But this issue of audit reviews, and sometimes auditors will make inquiries about large exceptions or things which are sort of, even if they're not dollar figures, things which are just look kind of weird. And auditors are very good usually at sort of sniffing out difficulties within an organization and reporting them up through the chain of command. And really they report, the entire auditing department usually reports to very top management, oftentimes bypassing the CEO, going all the way to the audit committee, which is a function of the board of directors itself. And so sometimes they sniff things out. And I've seen this happen before, where things operationally, which have really nothing to do with dollar figures at all, are sort of going out of whack, and auditors are all over it. They're saying, you got to fix this. And that's part of their job. And it's part of the value of having auditors in the first place. So, all right, anyway, that's all I really want to get into with regard to management by exception, but it's something that is it's sort of a style of management. Okay, so any questions before we get back to our friends at Zonic Tonic? This is the company that makes the high caffeine drink that goes to, I guess, convenience stores. And so here we have materials price variances. Okay, so remember, and this is zooming way back out, we have three categories of product cost, right? Materials, direct labor, manufacturing overhead. And within these categories, we have price variances, which are dollar variances, and quantity variances, which are expressed in terms of numbers. Okay. And then we'll get to the issue of what's controllable, what's not controllable, particularly as it relates to overhead. But let's talk about materials first. And so in this case, we've got a materials price variance for Zonic Tonic, which we've been covering throughout the this particular segment. We've got these input materials here. We have these quantities purchased. These are quantities and price. So price times quantity, price times quantity. And we have a standard price that we arrived at as $3 per unit of this whatever X1 is, $2.80, $5.10. But notice that there's a difference in price. You can look, I mean, it doesn't take a genius to say, well, $3 is $3.10, actual is higher than $3. The standard price, $2.75 though is less than standard price, so that's pretty good. The $5.20 for this particular unit is higher than that. So as a result, what do we have? If we're taking these quantities times the actual versus the standard, we have an unfavorable variance for this input, favorable for this, unfavorable for this. So if you simply add these up, and by the way, all you really need to do is where it says unfavorable, put a negative sign, positive, negative, negative, positive, negative, and you get a 420 negative variance or unfavorable variance, because it meant that we're spending more than what we budgeted for this particular level of output. Okay, now, here's where I think it's important for us to stand back and say, okay, there's a variance, and I don't know how much the revenue this, I mean, if we did 40 million in revenue for this, which I doubt is the figure, but I mean, a $420 variance is not at all a difficulty. It might be praiseworthy, but that really doesn't matter. We have an unfavorable variance, but here's the thing. If we explain the variance, first of all, these two variances cancel each other out. The favorable and unfavorable variances cancel each other out. The entire variance is this input unit here. But look at the explanation. There's a rush order. So maybe we have to pay more for shipping costs to get these goods to be inputted very quickly. This goes back really to incremental analysis, which we talked about in chapter 15. The idea that sometimes what doesn't look obvious as a particular job or order to be filled may make sense if the incremental revenue exceeds the incremental cost. And maybe it's worthwhile to pay the extra cost because we have a rush order what we don't have here is what the buyer has paid us for. And so maybe the incremental revenue is far greater than what the costs or total cost of this particular order, which we don't really know. We don't have labor, we don't have overhead, but it may make sense. And all I'm saying is that sometimes these explanations are what have to be answered. We just have to find out what's going on. We don't know always what the story is, and I think that's really what's going on. So who's looked to then to provide the answers? A lot of times it's accounting staff who can point out what's going on. Okay, and so when we talk about income statement presentation, it's not really an income statement like what we are used to seeing, but we will talk about this and we'll sort of close the loop, I think, on the difference between the internal reporting and the external GAAP reporting. So under a standard system, the cost of goods sold is stated at standard cost, and the variances are disclosed separately for internal purposes. Okay, why? Why would we do that? Well, okay, so we're saying for whatever the level of output is, that if we've assigned standard cost, which includes all the costs which go into product cost and ultimately the cost of goods sold, we're going to report those internally at standard cost. And if there are variances, it indicates to management what is going on, that we've got variances and where they are, what direction they are, how big they are, and what particular areas. Is it materials? Is it labor? Is it overhead? And then if there's a big issue, it kind of ties back in this issue of management by exception. Let's say you've got one gigantic, it could be positive or negative. But the question is why? Why? And let's drill down into it and find out what's going on. If it's favorable, maybe we're doing something that we should replicate across the organization. Okay, who knows? If it's unfavorable, maybe we just need an explanation. It's not every unfavorable variance means that someone's head is on the chopping block. It just means we need to understand what's going on. And again, tying in all these various factors we've talked about with incremental analysis, maybe it makes sense. So as I said at the outset, unfavorable variances will increase cost of goods sold. Favorable will decrease it, which means what? Well, the unfavorable variance, it increases cost of goods sold, it will lower net income, hence the term unfavorable. Favorable variance will decrease cost of goods sold, raising net income, hence the relationship to variable. Okay, that I think is pretty straightforward as to what's going on. So anyway, what are we trying to do in this particular example? We're trying to get to income statement presentation. So here we go. This looks like an income statement like what we saw in 2110. For those of you who took that here, we had sales, cost of goods sold, gross profit. That's the first section of the multi-step income statement, the three-step statement. But here's the thing. This is not a GAAP. This is not prepared according to GAAP, because GAAP statements do not usually carry variances in terms of materials price, materials quantity, labor price, labor quantity, overhead, which is all together. And by the way, overhead very often is reflected in terms of cost behavior that is variable and fixed. And we'll get to this idea a little bit later. We sort of open the door to that a bit. So in this case, we have an unfavorable variance of $3,000, which essentially does what? Adds to cost of goods sold, or by inference, it lowers net income. So 18,000 gross profit is reduced by 3,000 because we're actually adding this to cost of goods sold. So we have 15,000 gross profit, and then we have all the other selling, administrative, and all the other things which will go a little bit further down, but this is not a GAAP statement. You probably would not see this on a financial statement. And remember, as I've said a lot of times before, college accounting courses usually take the orientation of a publicly traded corporation, and where the information is going to be presented to investors in a format that is understandable. It's based upon GAAP standards, and these are not really going to be required. First of all, the reason why you're not going to report those is probably because you don't want your competitors to know what the variances are, and maybe how good or how bad you are at budgeting. And that's sort of an issue. There is sort of a rule of thumb, I think, in the corporate world that says if you're really bad at budgeting, you're also really bad at management. And I don't know that I completely buy that, but it's a thing. Okay, so maybe you don't want to reveal that, but it's important for internal purposes, and that's really what the main issue is. So these are not GAAP numbers; they are simply for internal purposes only. Okay. All right. So any questions about that? Let me see here if anybody on the Zoom link has any questions for me. Okay, quick review question then. Which of the following is incorrect about variance reports? A, they facilitate management by exception. B, they should only be sent to the top level of management. C, they should be prepared as soon as possible. D, they may vary in form and content. Well, which of these is correct here? Is it just top management? Is it just management? And which of these do you think is the right answer? B. Yeah, B. It's not just top management. Top management sometimes does not really want to hear about an exception for things like cleaning supplies or whatever. And this is this idea that we have a pyramidal structure in most organizations. And so the top level does not deal with these smaller issues. They're dealt with further down the chain of command. And so as a result, they don't always flow to the top. Okay. And one of the things about top management is, and it's sort of a recognized principle in management, is that if you're not prepared to deal with the big things, which is what you're always going to deal with, then it becomes really difficult. And I know that John F. Kennedy, when he was president, said that all the problems he got faced with were difficult because all the easy problems were dealt with lower levels, and he had to deal with all the tough problems. And so it's like, welcome to the executive world. Okay. All right. So taking a look here, let's move on to the balanced scorecard and what this is all about. And based upon the idea that there are various measures by which we hold management accountable. So we know that, and I've said before, that management really relies upon internal reporting to give information as to costs. And again, cost seems to be a major theme throughout managerial accounting, which is why sometimes a lot of accountants will just simply refer to managerial accounting as cost accounting. It's that important of an issue, but it's also involves revenues and these kinds of things, which really are important to achieve the firm's overall objectives. But there are other things as well that are important, and that we shouldn't be blinded to the fact that management is responsible for lots of other things as well. So, in which we would call non-financial measures. They have to do with things like customer satisfaction and lots of other areas. There's some examples given, and you can look at these for yourself. Automobiles, whether it's capacity utilization, which has to do with how well we're utilizing our facilities. And these are just examples of industries as well. Chemicals, whether it's customer satisfaction. Notice customer satisfaction keeps coming up as sort of a theme here. And that's a non-financial measure. Now, here's the problem with that, is how on earth do you measure customer satisfaction? These are benchmarks that managers are held accountable, but how do you hold managers accountable for things like customer satisfaction? How do you measure it? And it's difficult, and talk about management by exception. Sometimes it's customer by exception, because sometimes you really only hear from customers when they are extremely dissatisfied. And then you're going to kind of deal with the problem. And if you've ever had to deal with customers, and for those of you who will go into business, you will probably, very often their response is emotional and perhaps even threatening and whatnot. But you can't really measure that. So what you have to do is find some way to do it. Customer satisfaction data is important. But here's the problem. And I was in a seminar just a few months ago, and one of the speakers had said that the way that we measure customer satisfaction is breaking down, because everybody on earth is doing customer surveys. And to the point where nobody wants to do surveys as buyers because we're inundated with them. And I pointed out that it doesn't really make any difference. Like I take an asthma medication, so I go to CVS. CVS sends me a text, and I talk about how lousy their service is, because it just is. I mean, and they know it is. I talked to a pharmacist there. I said, we're too busy. We don't have enough people. You call there, nobody answers. You call the CVS, and nobody answers ever at the CVS I go to. And I report that, and nothing ever happens. And so it's a breakdown in the system. And that's a breakdown is the fact nobody responds to it because there's so much survey data coming in. And so nobody can deal with it. But also, the only reason I even did it in the first place is because I was a dissatisfied customer. But nobody really likes to respond to it. And we get this all the time. I can't tell you the number of surveys that I get, and you probably get as well. And nobody wants to fill them out. So how on earth do you measure customer satisfaction? Really, the best metric is revenue, I think, in terms of repeat sales. And this is one reason why the retail industry, particularly retail grocery, figured out a long time ago one way to study their customers and find out what their patterns were to have the value cards, the numbers that you scan in, Smiths and Albertsons, you use your phone number or whatever, and they do a lot of data mining to find out what your actual behavior is. Actual behavior is probably a better metric than what people report on a customer survey. So you don't get angry guys like me. I'm not that angry, but I mean, I don't like it when nobody answers their phone, but you get the idea. You sort of weed out those. You can aggregate much more data, but it's a problem because people aren't filling out this information. It really is hard to know what customers are satisfied. You really have to go with their behavior. So it's a problem. It's a thing, okay? All right, so let's talk more about balanced scorecard. This is one thing I said at the outset is that there are all kinds of different forms for how a balanced scorecard works. And these are, again, to assess management performance. We think of financial as being the big one here. And frankly, in a lot of cases, it is. I think the placement of this in the forefront makes a lot of sense, whether you like it or not. But also customer orientation, how well we're managing our internal operations is important. And then anything related to staff growth and development is also important. These are all important things that managers are responsible for. Some of these are what we would call soft skills, right? Whether you like that term or not, some don't like the term soft skills. That is the idea of dealing with things which are more high touch, more interpersonal, less objective, like revenue and cost and whatnot, but they're nonetheless there, okay? And the key goal is to incorporate these measures, both financial and non-financial, through what we call alignment. And the alignment are the big picture goals to what our management measurables are. We got to find a way to measure them. And I just talked about one area where it's difficult to measure customer satisfaction because of the fact that we're absolutely just inundating buyers right now and really can't get good information. And the survey thing I think is breaking down. By the way, it's even making its way into politics where the polling for elections is really faulty. And there are lots of surprises during the recent election simply because of the fact people don't respond to it. People are just absolutely inundated with people wanting information from them. And they don't want to give it. They don't. I mean, it's like, why do I want to take my time to give you information for free? And I mean, can you fault people for not wanting to do that, right? So you kind of get the idea that when we're talking about these users and external people external to the company, it becomes really difficult to measure. There are ways to do it, and in particular, when it comes to new product introduction and whatnot, and those are more marketing issues, which I think I'll set aside. But the key factor is we're using accounting data for the most part to assess management performance through what's called the balanced scorecard. And so these are some examples. And again, I think I mentioned at the outset, there are all kinds of different organizations for these, again, financial. And so here are some of the objectives. And some of these, the better scorecards, okay, should have precise standards. So there's a reason why the balanced scorecard approach is discussed in this chapter is because it lends itself to setting objective standards. When we think of standards, we're thinking of benchmarks to be met, goals to be hit, and to the extent that we can quantify those, all to the better. Some of these are difficult, particularly when it comes to this area here, which comes to personnel management. And this is probably the very definition of so-called soft skills. How do we measure this idea of employees who are cross-trained and ready to move up and ready to go to different areas. We can measure in terms of hours they spend in training. That's one thing. We can measure in terms of ethics violations. Hopefully, the lower the better. Reportable accidents. I like this one a lot. There are some organizations that are absolutely fanatical about trying to prevent injuries among employees, and some have. I think 3M, the company that makes Post-its and Scotch tape and all that, will have a running tally of how many days they've gone without an injury. And it's important, and that's a measurable objective. Number of days is a very measurable objective. So these are ways we can hold managers accountable for their performance. And also things like stockouts. Stockouts are where we have no inventory on hand, and so there's zero inventory. Again, I know zero inventory is more of a fantasy than it is a reality, because you have to have some inventory on hand in order to sell it. But these are all things that can be measured, ideally, right? Certainly the financial measures. We've already talked about this back in chapter 10, ROA, return on assets, income, credit rating, maybe not so much, but share price, certainly, profit per employee. All these are, and there are all kinds of metrics. There are just gazillions, dozens and dozens of measures that are financial in nature. Okay. All right. So which of the following would not be an objective used in the customer perspective? So this is just from the customer angle here. What would we want to talk about? A, percentage of customers who recommend a product to a friend, to the extent that we can pick up that information. B, customer retention. This is a big one, and this is one reason why, particularly a lot of retailers want to track customers, tag them with their own, if it's the phone number, email address, whatever, you know, how much they spend, what they buy, how often they come back. That's an important number. Brand, so that certainly qualifies as kind of key to the answer on that. Brand recognition, earnings per share. So which of these would be the customer perspective? These are non-financial measures. So the answer to this one is what? Earnings per share. Okay, because that's purely a financial measure. The rest are ones that we can measure, hopefully. And remember, we're trying to get these to be measurable, quantifiable metrics, percentages, retention, which is based upon percentage of customers that we retain, brand recognition. That's a little bit more difficult, but it can be measured. And if you take marketing, you probably get into more examination of how that works, and earnings per share. Okay, earnings per share is obviously very measurable, and it's not a customer metric. Okay, any questions so far before we move on to, we got just a couple things more, and then we'll talk about some issues regarding variances, and that'll be it for the content. We'll set ourselves up for coming back on Wednesday, talking about some examples, and then talk about the exam. So to sort of wrap this up here, there's a lot going on. It employs both financial and non-financial measures. These linkages are what we call alignment between the overall goals and what's going on within the organization. And by the way, this is not always a given, is the idea that whatever the company is striving to do should be communicated throughout the organization so that managers are all pushing and pulling in the same direction to meet the overall objectives. I can tell you this is not always the case. The first company I worked for had strategic goals which they did not communicate to us in the lower levels of management. I only found out once I got into senior management that we were being hoodwinked, but they didn't want their competitors to know what they were doing. That's a pretty dysfunctional situation. I was working in banking and we had deposit growth goals, when in fact the company wanted to lower deposits because they didn't want to hit statutory maximums because they couldn't take over other banks. But we were given these goals, and to me, a lot of people felt betrayed, and they felt like they were being misled, and they were. And it was not a particularly healthy environment to work in. And as a result, we have lots and lots and lots of turnover. And eventually the company got bought, and the top management was swept out, and they were off and on their way. The key thing is the alignment has got to be there so that people know what they're doing and why. Jobs are more meaningful when we know what it is that we're trying to do. And we don't know what we're trying to do, it makes it very unmeaningful, and it's difficult. And again, I underline the term measurable. They should be objectively measured. If you can't measure it, you can't manage it. It's a management axiom, and so as a result, the better measurability that allows us to assess what performance is and whether or not it's moving in the right direction. And it takes all the goals together and puts them in, and so we have the term balance. And so there's a weighting. There's no real art or science to this. It is based upon whatever management's thinking is in this area. Now, I know that industrial psychologists have come up with a variety of different scorecards and for assessing management performance based upon the impact that individual managers have. The case is being made that if you need managers, and I think there's no question that we can't just let AI manage organizations, not yet at least. So if you need managers, then you have to determine what it is managers are actually there to do. And if you take their relative performance, it's not all financial measures. Some of them are non-financial measures, and some people are just only there to manage people, and that's really what they do. So the weighting of that is more in terms of supervisory skills and things like training and development and keep making sure that skills are refreshed and all these kind of things. So in that particular case, that's fine. If you're a production manager, it's more about just cranking out the volume, and maybe personnel management is not a particular heavy weighting in the balanced scorecard. It really depends. And so I don't think you can take any of these categories. And by the way, there are probably other categories, not just, customer and operational and all that, probably other categories we haven't included that depending upon the kind of firm itself, whatever the organization is doing. And the weighting is different depending on what the job itself is. And that's really what the whole notion of this is to arrive at something objective. By the way, it also sort of protects the firm because if you set a standard and managers are unable to meet it and consistently unable to meet it, then it allows the firm then to make some kind of action as to maybe replace that manager or to take some kind of action. And I know this is not something that is a very pleasant concept, a pleasant conversation, but there are occasions in which managers simply are not up to the job, and there has to be some decision to be made as to what to do with that particular manager, particularly when others in their same peer group are achieving their objectives and one is not. And it doesn't always mean terminating the worker. Maybe it just means that particular manager needs to be put in a different job. And I've seen cases in which managers are in the wrong job. They're just in the wrong job. They don't belong in management. They belong somewhere else. And they're put somewhere else and they flourish. And that is a good outcome. It's not always the case that we have these good outcomes. I would love to tell you that it's always subject to good outcomes, but sometimes it does. And sometimes it really depends upon finding the right opportunity for that particular manager. Okay? All right, so that sort of does it for the balanced scorecard. The one thing I do want to do is sort of wrap this up before we're going to talk a bit about overhead variances and the concept of controllable versus uncontrollable. We've got one more example here, but I want to make sure that we have no other questions. I don't see anything in the chat box just yet. All right, so let's do one problem here, because we talked about this idea of variances, and we said, okay, if it's an unfavorable variance, it's going to add the cost of goods sold, lowering net income, or gross profit, which is translatable to lower net income. If it's favorable, it lowers gross profit, lowers cost of goods sold, raises gross profit, and hence net income. But how do we report this, and how do we sort of deal with this, particularly from the internal reporting standpoint? So let's take a look at the example here. This is, again, not the Exonic example, but it's a different example. In your text, polar vortex experienced the following variances. Okay, so we've got materials price, materials quantity, labor price, labor quantity. So we've got these three categories, right? Materials, labor, and then overhead. We've got one category, it's $800 favorable. We're given sales revenue, and we're trying to build an income statement for internal purposes, but also to compute the variance based upon the actual versus standard performance in the price and quantity categories for materials and labor, and then also in terms of overhead. So we got sales revenue, 102,700 for whatever the period in question is. Cost of goods sold at the standard, right? At the standard, and we don't know what the breakdown is. It doesn't really matter. It was 61,900. But we want to determine the actual gross profit. Remember, at the end of the day, what the accounting staff is there to do is to be able to contribute to a reporting to external users. But internal data is the source for this. And so let's take a look at what we're doing here. We get to see we go up. So sorry about that. So let's take a look here. Let's just report the information we've got. Okay, so we've got direct materials, first of all, right? Okay, we have direct labor and we have manufacturing overhead. Okay, within direct materials, we've got this issue of materials price variance and materials quantity variance. Okay, and we're given the materials price variance is $250 favorable. And again, you could translate favorable to a positive sign, unfavorable to a negative if you want to do that. We also have materials quantity variance of $1,100 favorable. So that's good, right? That's pretty darn good. These are all part of direct materials variance. In terms of direct labor variance, we've got labor price variance, which is based on wage costs of $700 unfavorable, and labor quantity variance of $300 favorable. Okay, so a little bit of a mixed bag when it comes to that. And then manufacturing overhead is all lumped together here. We get so manufacturing overhead is $800 favorable. Okay, if you simply add these up here, we're going to get a variance, total variance of $1,750, and it's going to be in the favorable direction. Okay. Now, what are we doing here? We're trying to take the variances for these product categories, and we're trying to adjust cost of goods sold, because when we're doing the initial reporting, we're going to use standardized cost. And by the way, why would we do that again? Because it sometimes takes a bit of time for us to figure out what these variances are, right? These are not things that immediately pop up. There's something, this is in itself historical data. It manages one information fairly quickly, and what generates revenue is going to be presented, and that's going to be fairly quick in terms of reporting. And so we're going to understand what that is fairly soon. But the variances, we're going to have to figure out what's going on at some point. Okay. All right. So what are we given here? We have cost. So the initial figures were cost of goods sold, which is at standard, right? Was 61,900. And we want to make an adjustment for the variance. And so the variance here is going to be this idea of a positive variance. Remember, the positive variance is going to lower cost of goods sold, right? So we want to make that a negative. And so we have the cost of goods sold, and we're going to call, this is going to be at standard, right? And this is going to be at actual, which is going to go over to the actual income statement. So 61,900 minus 1,750 is cost of goods sold is 60,150. Does everybody see why we're subtracting this? It's because a favorable variance reduces cost of goods sold. It's favorable in the sense it adds to net income. And one way you do this by lowering the cost. And so you've done it here in actual terms by lowering the cost of goods sold. So the question then was, in the final bit here, was to determine what the actual gross profit is. The actual gross profit is simply sales minus cost of goods sold equals gross profit. And we're given the sales of 102,700. That's not changing. That's, I mean, it is what it is. Cost of goods sold at actual is 60,150, which is what we calculated at actual. And so as a result, we get, I'm a little bit offline here a little bit. So, and we get gross profit. Gross profit here is going to be simply the difference between sales and cost of goods sold. And that's going to be 42,550 by my calculation. And this is going to be gross profit, and this is going to be at the GAAP number. This is actual or at GAAP. And so that would be what's reported for external purposes. And by the way, one final thing I'll say about GAAP reporting is that sometimes companies that are publicly traded want to get their numbers out as quickly as possible. They usually set up a date where they say, these are the numbers we did on a quarterly basis. Publicly traded companies report on a quarterly basis at minimum. And sometimes they don't have these available. And they'll say these numbers are non-GAAP. And the investment community is just going to have to kind of take their word for it that they're pretty close to GAAP, but they sometimes have not made these adjustments yet. We see this It's not an everyday matter, but it does happen where companies will say, these are non-GAAP numbers, do not, hold our feet to the fire on this. We will give you GAAP numbers at some point. And that's really an issue there. So generally accepted accounting principles are those that are based upon these adjustments having been made. Okay. All right. So any questions about that before we move on to the final bit here, the last segment of the course? And I'll leave this up here, and obviously if you're watching the video, you've got that. And if you have questions, feel free to contact me. But let's talk about the final bit here. And it really has to do with this idea of, once again, a variance and what we do about it. Okay. All right. So, and in this case, we'll talk about the idea of what we call controllable and volume variances. And we're going to sort of say that one of the variances, whether it's price or quantity, is controllable. The other is, I would say, less controllable, as opposed to non-controllable. Maybe the better word is less controllable. I think a lot of managers believe that in the long run, everything can be controlled. In the short run, not so much. I think that's one of the realities of cost management. Sometimes you're stuck with what you've got for the very short term, but in the longer term, not so much. So we talk about overhead. Again, what is the definition of overhead? This goes back to really very early on where we said overhead were these things which are indirect costs. And they could be indirect labor, indirect materials. They could be costs which are so minuscule in terms of product costs that they can't be really easily calculated, whether it's adhesives or paint or, a lot of paint vapor evaporates and, that sort of thing. So we have to figure out a way to attach those to product cost. And so we talk about variances here. We're talking about those which are controllable and those which are more controllable. Overhead controllable, really, they tend to deal more with variable costs, frankly. And the volume variances have to do with quantities. And in this case, they relate to whether fixed costs were under or over applied. And this implies then, my input here is whether fixed assets were employed efficiently or whether they were not employed efficiently. And whether they were not, is there a reason why they were not? And there could be reasons. It could be the economy's in a recession, and so as a result, business is down. And so yes, you're not moving as much inventory. You're not utilizing your factories at 3 shifts. You're not using all of your delivery trucks. All these kind of things are examples of fixed asset employment. But again, if an explanation is rational, it's rational. So what about controllable variances? They show whether or not we can control them well or not. And there are some costs which are under control, some are not. So in this case, we're going to compare actual versus standard. And where does the standard cost come from? Well, we've talked about this early on when we first started talking about overhead. It's really an outgrowth again of the budgeting process. And I know when we first started talking about overhead, I said that we're going to sort of kick the can a little bit down the road, and we're going to say, okay, we're going to arrive at a predetermined overhead budget for this organization. It's a big global figure, and we will slice and dice it and drop it onto different areas within the organization itself. We're going to arrive at it based upon our rational expectation of what we think we're going to be incurring in terms of these things like indirect labor, indirect materials, whatever, things like depreciation on factory equipment, all that sort of thing. So we do it then, as we go throughout the year, as we go throughout the reporting period, we have to set standards so that we can assess where we are. If we don't know what we expect, we can't know whether or not we're on track or not. We've got to have some sort of benchmark, and that's what a standard is. And so the budgeted costs, again, come from this overhead budget that's arrived at usually before the fiscal period begins, okay? And I like the term flexible budget. I think that's an area that needs further explanation. And for those of you who are accounting majors and will take cost accounting, you'll get into more of this idea of flexibility in budgeting. I think I would say it's the wave of the future, but it's really here now. A lot of companies are simply adjusting budgets very, very quickly, and they can do it based upon very good feedback that they're getting from processes. Okay, so we'll go back to our guys at Zonic. And so what do we have here? This is one particular period which we've got these kind of facts going on. We've got variable costs, variable overhead costs and fixed overhead costs. The fixed overhead costs are $4,400. Those aren't changing. I guess these are quarters, right? 4,400 all the way across, but the variables are changing. And the variable costs are based upon all those categories that we've talked about, a lot of which initially, when we very first started talking about overhead, a lot of them really were frankly variable overhead costs, but we didn't get to the idea of variable and fixed yet. Remember, variable and fixed are simply delineations of costs based upon behavior, how they behave. Indirect materials go up and down with output levels, same with indirect labor, and the same with utilities. And so we're saying in this particular category, $6,000 is going to be incurred in the variable cost category, fixed cost, $4,400. Whatever that is, it's, well, I guess mostly it's supervisor salaries and depreciation, right? It's broken out. It's broken out for us. So we're saying that we've determined the predetermined overhead rate is $3 per hour of labor plus the fixed cost. So in other words, it's the variable cost at $3. And so this is a traditional costing system, right? This is not activity-based costing where we simply pull in whatever metric we want to use, whether it's machine hours, which is a very common one, in particularly manufacturing, where it's repetitive process costing type stuff, or whatever. But labor hours are perfectly acceptable, particularly when labor is a big piece of it. So $3, okay? So in this case, what do we have here? We're given actual. The budget was $10,400. Where did that come from? It just came from the foregoing, where we had fixed and variable. It's in red for the second quarter, $10,400, based upon the fixed and variable components. But we ended up with, those were the standard items, standard budget for overhead. The actual was $10,900, and it looks like we had $500 of variable and $4,400 fixed. So the variance here is unfavorable. 10,009 is higher than 10,004, where actual exceeds standard. It's an unfavorable variance, and the entirety of the variance is in the variable piece of this. Okay, that's the entirety of the variance. So we can point to that. Now, whether or not we want to do anything about it as managers, I say we as if we're managing this company. It really depends upon whether or not we want to. Who knows what this variance is due to? And maybe it's fully anticipated. We may even be thinking our lucky stars that it's not worse than it was, because maybe it is a rush hour. Maybe it is a rush order. Maybe it's a special order. Who knows what it is? But what we do know it is, we do know what it is a variance. And it's an unfavorable variance. And so we'll add to cost of goods sold. And whether or not that's a big issue or not is an issue for down the road. Okay, so let's talk about volume variances. So that's a price variance. What about the volume variance? We have the fixed overhead rate, that was $3 times the normal capacity hours minus the standard hours left. This is a quantity variance going on right here. Quantity variance, or in the parlance of managerial accounting, volume variance. I kind of wish they would not bring in different terms for what is essentially the same thing, but volume really takes into account the idea of applying the overhead rate to it. So in this case, what have we got? This is kind of busy. This is probably the last thing that we'll do today. We'll just take the facts given here, and we'll sort of work through these, okay? And let's not get freaked out about this SAT question of looks like a word problem. Let's just sort of take it one at a time, break it down, and analyze it. So we're saying fixed overhead cost for the year is going to be $52,800, okay? And at normal capacity, which is our standard capacity, we're gonna do 26,400 direct labor hours in order to do whatever the projected volume is going to be. The fixed overhead rate is $2 per hour, which we get to by taking the total fixed overhead divided by these direct labor hours, which is the driver, right? Overhead. This is the driver, labor hours. So we get $2 per hour. All right. Which, by the way, if we go back to, and these do tie into one another. We had 2,000 units. Well, I guess these don't tie together. Anyway, it's $2 per hour. I was thinking they do. So in this case, the month of June, 1,000 units were produced. Standard hours were for 1,000 gallons. That's the output level. This is the output level. Produced was 2,000. That was the 2 hours, right? 2 hours that were needed. That's the quantity assigned to the amount of output. Is 2 hours per unit of output. I think that goes back to where we really began with So 2,000 hours to produce 1,000 gallons, that's the standard. But in the month of June, we actually, normal capacity is 1,100. We only actually produced 1,000 gallons. And standard direct labor hours were 2,200, 26.4 divided by 12 months. And that's how we break it down. So in other words, what is the computation of the overall volume variance? So there's a lot going on here, and a lot of it has to do with the difference in performance. And the big issue here, the elephant in the room, is the 1,100 at standard quantity, and the 1,000 actual quantity. That's really where all the variance lies. And so let's take a look at what that looks like here. So the fixed overhead rate, which was predetermined, is $2, right? And that was the fixed overhead rate. The difference was between the normal, or what was done, minus the standard. So for 1,000 units of output, it should only have taken us 2,000. That was 2,000 hours. Instead, it took us 2,200. So we have a variance. So 2,200 minus 2,000 is 200. Times 2 is 400. It's unfavorable. The reason it's unfavorable is because the standard is less than the actual. So as a result, we have an unfavorable variance. And it's all really due to this difference in performance in terms of quantity variance. And again, we don't know what's behind this, just in looking at this as sort of a generic example. We don't know what's going on here. But I think that's what we need to understand. And so this is really what's part of the issue here. So rather than saying unfavorable variances are always bad, and therefore managers, you're terrible, you're on the chopping block, let's find out what's going on. And it could be things that are uncontrollable. It's not always the case that these costs are controllable. Some are controllable, some are not. Let's talk about this. And this is really the very last thing we'll get to. And it's the idea that when we talk about variances, we're going to use standard. If it's hours that we're using here, labor hours as the driver, then we're going to use the standard hours. And the budgeted costs for this controllable variance, that is things which are thought to be under the control of management, where do these budgeted or standard costs come from? They come from the budgeting process itself. And the controllable variances tend to pertain to the variable costs. Why? Because the fixed costs generally are fixed, and there's not much you can do about them, particularly in the short run. And I said there's some wiggle room there, but for our purposes, let's just assume that in the short run, which again, as we've defined the budgeting period as being a year, let's say, I think that's pretty agreed upon. There's not much you can do in terms of changing those. In the long run, yes, okay? And then when it comes to volume variances, they pertain really only to fixed costs, and that is how well we're utilizing our fixed assets, how well our supervisors are working. And so you've got price variances, which really relate more to variable costs, and volume variances, or quantity variances, whichever you prefer, are related more to the fixed costs. And again, inputs create costs, variable inputs create variable costs, fixed inputs create fixed costs. And so as a result, some of these are considered controllable, most of the variable costs, particularly in the short run. And maybe you can do things like controlling things like overhead, it relates to labor, or taking discounts on materials. All these are elements that are under the control of management to the extent that they are. And again, if they're big variances, they flow to the top. If they're small variances, maybe not. And there is some wiggle room within these, even as it relates back to the balanced scorecard. There is some variance that is permitted. We are not going to hit every number on the dot, but it is something there are certain tolerances that are allowed, and those tolerances are really determined by management, who are also looking at what we need to do in order to perform relative to our peers. And so we go all the way back to where we talked about in chapter 10. It's not just about how well we're doing, but how well are we doing in the industry relative to others. And that's often a good benchmark. And that's one of the things that competition does, is it serves to keep everybody on their toes. As much as we all hate competition, nobody likes it, but it's a fact of life. And in our legal system, really encourages competition over non-competitive situations, mostly for the issues of, for these reasons: efficiency, cost containment, and and delivering good results to all stakeholders. Okay? All right. Any questions for me? Because we're about out of time. We got about a few minutes. So if anybody has any questions, I can answer any of them. Anybody have any questions? Okay, when we come back on Wednesday, I'll do some examples of the back of chapter problems and exercises, and I'll also talk a bit about the exam. And so look for that. And in the meantime, if you have any questions, I'm here all day. So feel free to contact me. See you next time.